So Friday we had a pretty normal day. In fact, it was a monthly expiration, and so we saw that kind of grinding motion that we can get as we move towards a big strike price. And so, everything seemed normal until, of course, around 4:45 we got the news that Moody's downgraded the U.S. debt rating from AAA to AA1, and the market sort of, we saw the futures move lower on that news, and we saw bond yields move higher. Mixed opinions out there in terms of whether or not this will actually matter. Um, it could matter in some senses, but in the most part, it doesn't really change much, though, from a mechanical standpoint. The thing is that the market, though, has become so lopsided to the bullish side of things. So this is, for all expiration dates, the S&P 500 delta exposure. And what you see here is that it's all positive, all green. And that's basically because we've seen, a shift in market sentiment from being really bearish to really bullish now. And when we look at the open interest levels, at least, this was as of Friday morning, doesn't include obviously what took place Friday. It's kind of easy to see that there's just, a lot more open calls than there are open puts. And obviously, as the market rises, the delta value for those calls increases and the puts delta decreases. And so that gets you this sort of, skewed image of just a lot of bullishness out there. And when we look at the volume, at least trading on that day, you can see a lot of it was traded around this 6,000 level. And when we look at gamma exposures, it's also very similar. When you look at the volume, a lot of volume trade at the 6,000 level. And again, when you look at it from this perspective, 6,000 is really going to be a very difficult level to breach, at least to start next week, unless there's some sort of news that's positive. This is going to kind of put a defining line in the market, at least I think, until this can be chipped away at, and these levels start rolling higher. But as of right now, 6,000 is sort of the wall that's going to be pretty tough to break, I think, at least to start the week. Now, because the market has turned so positive, and because we do have this big wall here, it may actually be one of those situations where, because of the Moody's downgrade, even though it may not mechanically change anything for how debt issuance works, so to speak, it could still trigger something. And the reason why I say that is because the VIX, obviously, volatility levels have fallen a lot since they peaked, in mid-April. And I was already kind of talking to members during the week about the implied volatility of the VIX, which is the VVIX, which had been already starting to move higher, which is an indication that the market's kind of getting ready for higher implied volatility. That's the way that I think about it. So we also have another complicating factor this week, and that is that the VIX OPX, and at least when I look at the VIX, we see is that there's a big level of gamma here at 17, which should likely act as a support level for the VIX in terms of going lower. When we look at the delta exposure, you can see it's all very negative. So just like the S&P is all very positive, in terms of the VIX, it's all very negative. And what that means is there's a lot of put exposure that's in the money, and you can see, puts outweigh the calls, at these levels. And so what this kind of implies to me is that the news on from Friday could be enough that it triggers a pop in implied volatility. And because we're getting into option expiration for the VIX, let's say if you were to get a move higher in the VIX to, let's say, 19, that could start, leading to some of these delta exposures then beginning to deteriorate, and that could lead to a little bit of a push higher in the VIX, and that could lead to some of these flows shifting from pushing the VIX lower to potentially pushing the VIX higher. Could mean that if you start seeing the market move down, these delta values will start declining as well. And that could lead to, call owners becoming sellers. And that could lead to obviously a bigger decline. So the market is susceptible here for a move down because it is so bullish at this moment in time. It's just like when the market goes down really hard and fast, it's oversold. And in this case, the market is completely overbought. And when you could specifically see it when you just look at the option positioning. So you could imagine that if, you got a move lower and you got a pop in the VIX, and all of a sudden you're going into OpEx and, these puts are going to start having to be closed out, let's say they start burning value, you could see the VIX really begin to move up. And if the VIX starts moving up, you're going to see the S&P 500 move down. That's one scenario. I think that's probably the worst case scenario for the market following this debt downgrade. I went back and I looked at some of these other scenarios, and if you go back to like August of 2023, this was the Fitch downgrade, and it led to a decline. It triggered an event, and that led to the decline that we really saw going into late October. And over that same time, you saw 10-year rates move higher as well. Here it is right here. You could see rates initially moved higher, they came down, and then they just then they continued to grind higher into that end of October peak. If we go back and we look at 2011, the exact opposite happened. In fact, when we got the downgrade in August of 2011, rates actually came down really sharply, and they continued to go down all the way into 2012. And that was largely because of what was happening around the rest of the world, and really had to do with also the fact that, the U.S. was in the middle of its own negotiations on the debt ceiling. Plus, you had the European debt crisis going on at the same time, and that just complicated things. So there was actually a rush to safety in that time period, pushing rates lower. When we look at the S&P 500 over that same period, and we just look at that time, you can see the market was already actually coming down into the downgrade. This was the actual when we opened after the downgrade, also occurred on a Friday. You can see we fell nearly 7%. The next day we rallied back 5%. The day after we fell 4%, and then we rallied back 4.5%. And then we just chopped sideways because there was a lot of other stuff going on in the world. So I think to look at this news event and say that it's a definitive, or this is really bad, or this doesn't matter, it's hard to really make that distinction. And it's really hard to say exactly how the market will move. My guess would be is that rates were already moving higher, and this is probably just going to give the bond shorts and people who have been selling bonds another reason to continue to sell. Just because we know that the U.S. government is running a very large fiscal deficit, because we know that the debt burden continues to increase. We also know that the interest payments on the debt continue to increase. And we also know there's a large amount of debt that needs to be reissued before the end of the year. And so they can't really do that until the debt ceiling is resolved. And so, again, the trend is higher. I would think that probably means that the trend in the market for bond yields continues to go higher as well. Now, for the dollar has been generally weakening, and I would think that this would probably continue the trend of dollar weakening that we've already seen. In fact, if we go back to 2023 and we look at what happened to the dollar during that period of time, the dollar actually continued to strengthen. The dollar was already strengthening going into the Fitch downgrade, and it just continued to strengthen right into the October timeframe as well. When we go back to 2011, you can see here that the dollar was really weakening going into that event, and it continued to weaken. But then at the end of the month, past the event, you could see the dollar began to strengthen again, because again, there was a lot of things going on in the world other than just the U.S. debt downgrade. So, again, I think when you look at the market, what you're likely to see is just a continuation of the trends that we've already been seeing. The only thing, obviously, is that the S&P is sort of in a unique experience because I don't know which way the trend really is at this point. We just obviously had a very big decline. We've had a very big rebound. We had been trending higher. That trend was clearly broken. I mean, if you just draw a trend line from, here to here, the trend line has been broken, right? So we don't really have an uptrend anymore, at least over a shorter term view. I mean, obviously over the long term, the market has always gone up. So, but that doesn't mean that there can't be periods where it has prolonged periods of sideways or lower prices, which would be bear markets. And we really don't have what I would consider to be a definitive trend right now in the market, just because of all the things that have been going on. Plus, the positioning makes us really vulnerable to a pullback. Additionally, the other thing that I will throw out there, which isn't really like a hard science or anything like that, but it's very unusual if you go back and you look at charts and you look at them over history, to have unfilled gaps in the S&P 500 futures. And you have two of them within the same, month, basically. And so I would be surprised to see these two gaps remain unfilled for a prolonged period of time. So what I would say is that if the market needs a reason to sell off, there's a reason now in place for that to happen. The positioning is very bullish, and so because it's so bullish, it may be almost too bullish, and because implied volatility has come down so far, and we're going into VIX OpX, there could be a situation where you see a move higher in implied volatility because of the news lead to a bigger move higher in implied volatility, and a move lower in the S&P 500 as a result could lead to a bigger move lower. And with these open gaps, I mean, they become obviously the sort of targets for the market to look for if we do see it, come back. I mean, these levels kind of stand out at, 5,700 and call it 5,300. There's even one here at 5,570. So those would be the spots that I would think we could see the market pull back to in those cases. I mean, clearly here you can see the 5960 area is a resistance level. And if we get above that, then the next level is going to be 6150. I think the upside is pretty simple. It's really the downside that's more complex. And like I said, if there's a reason for the market to go lower, it has one now. It has a trigger for it to happen. And of course, President Trump is back from his trip. So we don't really know what's on the administration's agenda this week either. We haven't really seen any improvement in the Taiwan dollar, and we haven't seen any improvement in the Korean won. And so there's still obviously the possibilities that we could be hearing about chip tariffs really at any point, at any time over the next, who knows, week or two or three. So that's still another lingering issue out there as well. So anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, share it with your friends, and have a great weekend. Bye.